Okay, so we're looking at how can record financial transactions. All right, journal entries. These are the steps involved that you need to remember. But as you get accustomed to this, you won't need to follow these steps. Okay, but the first step is you identify what type of transaction you're dealing with. After you identify the transaction you're dealing with, you identify now the accounts which are involved. The assets, are the liabilities, is it revenue, is it an expense? Okay. And then you identify which ones are increasing or decreasing. Okay, here we're not using debit, credit the giver, debit the receiver. No, we're using increase or decrease. Then the third step, apply the double entry rules. All right, so we're going to look here. We've got some transactions here, right? And then we're going to look at how we can do these journal entries. Okay, so colleagues, yesterday we looked at some of the types of accounts involved with expenses, assets, drawings, liability, income or revenue, and capital. Okay, so we're going to start with our first transaction. Started a business with 100,000 kwacha cash. Okay, so first we identify the transaction. What is going on here? Well, this person, whoever it is starting a business. All right. So they're putting in money into the business basically here. Okay. So that we've identified the transaction, starting a business. Okay. Next, we need to identify which accounts are involved. So here we've got two accounts. We've got the capital account and we've got the cash account. Okay. Capital account and cash account. All right. The cash account is an asset account. Capital is just a capital account. Right. So after we've identified the two accounts, now we have to identify which account is increasing, which one is decreasing. Sometimes both can increase, also both can decrease at times. So in this case, both accounts are increasing. Okay. Remember, capital, this is the money or resources put into the business by the owner. That's one way to look at capital. Another way to look at capital is what the business owes you. Okay, so initially the business owed you nothing. Now you've put in 100,000 kwacha. So it means the business is now owing you something. Okay, so we can see there's an increase in capital. Okay, at the same time, the cash account for the business was at zero. So we've put in cash now. It has increased to 100,000. Okay, so we've identified both accounts are increasing. So now we're going to apply the double entry rules. Cash is an asset account. Increase in an asset, you debit. That's why assets is here on the debit side. Increase in an asset, you debit. So we're going to debit cash. Capital is a capital account. Increase in capital, we credit. That's why capital is on the credit side here. So we're going to debit cash, 100,000. We're going to credit capital, 100,000. Colleagues, any questions? Any questions? Remember, I do not rush, okay? We're all going to move at the same pace. All right. The main importance is for you to understand. Okay. So if you've got any questions, always feel free to ask. All right. Or where you don't understand, where you need clarification, feel free to ask. Okay, let me go to the next transaction then. transferred 70,000 cash to the bank. Okay. So here, the transaction, we're transferring money from the cash account to the bank account. All right. So the two accounts involved, the cash account and the bank account. Both of these accounts are asset accounts. So we have to identify which one is increasing and which one is decreasing. So since we're moving, oh, before I even answer, colleagues, which one is increasing and which one is decreasing? Let me see. Which one is increasing and which one is decreasing? We can start with Madam Charity. Madam Charity. Yeah, I hope I haven't chased her out. Someone put on the group, no, Madam Charity, come back. It's okay. Don't go. Mr. Emmanuel, do not worry, colleagues. Feel free here. Even though you get it wrong, there is no problem with that. We are learning. Okay. How you learn is when you get things wrong. That's how you learn, by getting things wrong. Yes, Mr. Ronald. Yes. Good evening. Thank you very much, sir. Although in this case, because we're transferring from the cash account to the bank account. So cash is reducing. The cash account is reducing. Okay. Then the bank account is increasing. Okay. Yes. So both of these are assets. Okay. Cash is an asset. Reduction in an asset, you credit. Okay. Reduction in an asset, you credit. Increase in an asset, you debit. Okay. So we're going to debit the bank account because it's increasing and it's an asset. Then we're going to credit the cash account because it's reducing. Okay. And with your journal entries, you always start with the debit. Never start with the credit. Okay. Always start with the debit. So cash, I mean bank, 70,000. Cash, 70,000. Any questions, colleagues, before we move to the next transaction? And can someone please call back Madam Charity? If any of you knows Madam Charity, say that Madam Charity, come, kindly come back. All right, we go to the next transaction. Bought goods, 15,000 for cash. So we identify this transaction. We are buying goods for resale. Okay, we are buying goods for resale. Okay, so the two accounts involved is the purchases expense account. Okay, because when you buy the goods, that's an expense to you. Okay, and then since we are paying cash, there's a reduction in our cash. Since we're paying cash, so cash is the other thing as the account that's involved. So the two accounts involved are purchases and cash. Purchases is an expense account, cash is an asset account. Okay. So, colleagues, whenever you incur an expense, just remember this rule. Whenever you incur an expense, just debit. Whatever expense it is, just debit. Okay, it will make your life easy. Okay, so here purchases is an expense, expenses you debit, increase in an expense, debit. Cash is an asset. We are paying money, reduction in an asset. So we're going to credit cash. All right. So we're going to debit purchases expense, 15,000. Then we're going to credit cash, 15,000. Yes. Any questions? Wonderful. We go to the next transaction. Okay. Bought goods on credit 7,800 kwacha from Mwal. So this transaction is similar to the previous one. The only difference is we haven't paid money this time. Okay, we haven't paid money this time. So the transaction is also, let me just turn my phone back on. Sorry, colleagues, my phone went off, so I was kicked out. Where was I kicked out from? Where did I get kicked out from? The first question. Oh, ish, I thought I had to go back. Yes, we're talking about this transaction here for bought goods for 15,000 cash. We identified the transaction, we're purchasing goods for resale. The two types of accounts involved here, it's purchases and cash. Purchases is an expense. Increase in an expense, you debit. Cash is an asset. Since we're paying out money, so decrease in an asset, you credit. Okay? So we're going to debit purchases expense, and then we're going to credit cash as I've done here. Any questions? Any questions, queries? Oh, ish. Okay, okay. Yes. So, colleagues, anytime I'm kicked out or I'm not sharing the screen, always let me know. Especially when I'm kicked out. When I'm kicked out, someone can call me. Say they have been kicked out because other times might be talking, find I'm kicked out. Are you able to see the screen now? Okay, let me just go through it one more time since yes. We bought goods for cash 15,000. Step 1, you identify the transaction. The transaction that's happening is here. We're purchasing goods for resale. Step 2, you identify the accounts involved. The accounts involved here are the purchases expense account and the cash account. We have to determine which one is increasing or which one is decreasing. In this case, purchases expense increase in an expense. Since we're paying out cash, decrease in cash. So then we apply the double entry rules. Increase in expenses, you debit. So you're going to debit purchases. Okay. Cash is an asset. Decrease in an asset, you credit. All right. For those who have joined in late, at least I think get a screenshot of this. This is what I'm using to do these journal entries. This is what I'm referring to. Okay, so get a screenshot or get a paper and pen, draw this thing down. Okay, and these steps, do not worry, I'll be repeating them over and over. Okay, yes, I'll give you 2 minutes to just draw this diagram here. Yes. As the others are drawing, colleagues, any questions on the previous transaction? As the others are writing down, any questions? Okay, I believe we've all got down this diagram. We go to the next transaction here. Bought goods on credit 7,800 kwacha from Mwale. So this one is similar to the previous transaction. The only difference is we never paid money. We bought goods on credit on Nkongole. All right. So step 1, we identify the transaction. This is a credit purchase basically. The two accounts involved, it's purchases, expense account, and now we've got a liability account in the form of Mwale. We've bought goods from him on credit, so it means we're owing him. Okay, so Mwale is a creditor. Okay, a creditor is a liability. Okay, so the two accounts, purchases and Mwale. Mwale is a payable. Okay, someone who we owe money. Okay, also called a creditor. Right. A creditor is the name of the person, then the amount that they're owing you is the payable. Okay, colleagues? Because you see these names interchanged. Okay, sometimes you might think they mean the same thing, but the creditor is just the name, then the amount they owe you is what is the payable. All right. So, again, the purchases expense increase in an expense, you debit. So, you debit purchases expense. Since we're owing someone, so that's like an increase in our liability. So we're going to credit Mwali. Okay, increase in a liability, you credit. All right, so we're going to debit purchases. Credit Mwale 7,800. Yes. Any questions? Wonderful. The next transaction, sold goods worth 20,000. All right. So here we made a sale. Okay. These are cash sales, basically. That's the type of transaction. Right. Step one, identify the transaction. This is a cash sale. All right. Step two, identify the accounts involved, cash account and the sales account. The cash account is an asset. Sales revenue account is a revenue account or an income account. All right. We identify which one is increasing and which one is decreasing. In this case, both accounts are increasing. You've made a sale, so money is coming into your business through the cash account. So the cash account is increasing. At the same time, also your sales revenue is also increasing. All right. So cash is an asset, increase in an asset, debit. Sales revenue is a revenue account, increase in revenue, you credit. So we're going to debit cash, 20,000. Sale, then we credit sales revenue, 20,000. Colleagues, any questions before we go to the next transaction? Good evening. Good evening, sir. Mm. You can put it as sales or sales revenue. Either way, you won't be penalized, sir. You can, yes, you can put it as sales or sales revenue. Sold goods on credit to Jonathan 5,000. So here we have another sale. Okay. Now the only difference is the one which was previous was a cash sale. Here we're dealing with a credit sale. All right. So step one, identify the transaction. This is a credit sale. Step two, identify the accounts involved. Okay. So there's a sales revenue account involved. Now here, since cash never exchanged hands, so what's going to replace cash is our debtor named Jonathan. Okay. He is owing us money. Someone who owes you in money in accounts, who's called a debtor, is regarded as an asset. The amount they owe you is what is called the receivable. Okay. So Jonathan is owing us money. He's our debtor. He's an asset. Okay. So those are the two accounts involved. Next thing, we need to determine which one's increasing, which one's decreasing. Okay. In this case, both accounts are increasing. All right. As I said, Jonathan is an asset. We've just acquired someone who owes you money. When you just acquire them, it's like an increase in your assets. Okay. Increase in your debtors there. It's an increase in assets. Okay. Then Revenue is also increasing. Okay. So we come back to the double entry rules. Jonathan, who is an asset, who is a debtor, increase in an asset, we debit Jonathan. Revenue, increase in revenue, we're going to credit revenue according to the double entry rules. So we're going to debit Jonathan, increase in an asset, debit. So we're going to say Jonathan, 5,000. And sales revenue, 5,000. Any questions? Okay. Now, Jonathan, the next transaction, Jonathan returned goods worth 1,500. Right? So we sold him goods on credit for 5,000. Then he comes back and says goods worth 1,500 can either be damaged, expired, or the wrong goods. So he's returned them back. Okay. So when a customer returns goods, take note of this. When a customer returns good, excuse me, we call it return inwards. Okay. We call this return inwards. Okay. Return inwards is a contra revenue account, meaning it reduces your revenue. Okay. We made a sale of 5,000. Okay. Remember, according to the accruals concept, even though you don't receive money, you're still going to record. So we made a sale of 5,000 and recorded we made revenue of 5,000. Now, the customer has brought back goods worth 1,500. All right. So that revenue which we recorded, it needs to reduce because some goods have been brought back. So the two accounts that will be involved are return inwards, also called sales returns, which is a contra revenue account. So since this is a contra revenue account, remember, according to the double entry rules, revenue increases with credit. So a contra revenue will increase with debit. Are we okay with that, colleagues? When a contra account has the opposite double entry rules, okay? Because it reduces the named account. So if you ever want to reduce revenue, you have to debit that revenue, okay? So sales returns or return inwards is a contra revenue account, meaning it increases with debit. Then Jonathan, who is our debt, who is an asset, since he's brought back some goods, so it's like there's a reduction in our asset. Okay, the amount that is owing us has reduced, basically, in simple words. Okay, so a reduction in an asset, you credit. So you're going to debit sales returns, 1,500, reduction in revenue. All right. Then you're going to credit Jonathan, 1,005, reduction in an asset. Basically, how much is owing you has reduced. Yes. Any questions? All right. The next transaction, returned goods worth 1,800 to Mwali. So if you remember earlier on in this question, we bought goods on credit from Mwale, 7,800. Okay, so we're owing him 7,800. Now, we've seen that some of the goods we bought from him could be damaged, destroyed, or the wrong goods. So we've returned the goods back to Mwale. Okay, so this, whenever you return goods back to your supplier, we call that purchases returns or return inwards. Return outwards, I mean. This is a contra expense account. Okay, it's reducing your purchases expense. Okay, remember our purchases expense at first was 7,800. Okay, now we've returned goods, so it means that purchases expense has to reduce. Okay, then another thing that is reducing is our liability, what we're owing Mwali. We're owing him 7,800. Now we've returned goods to him worth 1,800. So how much we're owing him also reduces. So here there's a reduction of two things: a reduction of the purchases expense and a reduction of the amount we're owing Mwale. So Mwale is a creditor. A creditor comes under liabilities. According to the double entry rules, liabilities increase with credit, meaning to reduce a liability, you debit. So we're going to debit Mwale. Then return outwards or purchases returns is a contra expense account. So expenses increase with debit, meaning the contra expense you credit. So a way to reduce your expenses, you credit. All right. So we're going to debit Mwale. Okay. Reduction in the liability. We debit Mwale 1,800. And we credit return outwards or purchases returns 1,800. Any questions, colleagues? Okay, the next transaction, paid rent 700 kwacha. We identify the transaction, we're paying for an expense. Okay, we're paying for an expense. The two accounts involved, the rent expense account and the cash account. Whenever you incur an expense, increase in an expense, you debit. Okay, so you debit rent expense. Cash is an asset since you're paying, so it means cash is reducing. So reduction in an asset, you credit. So you're going to debit rent 700, credit cash 700. Any questions? It's the same with this transaction also here. Paid insurance 600. Insurance is an expense according to the double entry rules. Increase in an expense, you debit. So insurance, debit 600. Paid cash. Cash is an asset reduction. In an asset, you credit 600. And then our final transaction. Got a loan from Zanaco 10,000 kwacha. We identify the transaction, we're obtaining a loan. The accounts involved, cash account, okay? Or here we assume bank because this money is going to the bank with a bank account. So the two accounts will say bank account, and we've got a liability here, okay? We've borrowed money, so it means we're owing, all right? So we're owing Zanaco, okay? So the cash account is increasing because, the bank account is increasing because we've got some money. Increase in an asset, you debit, okay? Bank is an asset. So increase in an asset, you debit. Zanaco is a liability. Increase in a liability, you credit. So you debit bank 10,000 and credit Zanaco 10,000. Okay. Yes. Any questions, colleagues?